Hello and welcome to a brand new show of Market Makers. Markets have managed to climb the wall of worry. We've put a super July behind us, but in the short term, is this as good as it gets? There is no bad news. Everyone is excited after the passage of the GST reform, and globally also the terrain is looking extremely favorable. Big earnings upgrade for US markets, Nasdaq at a record high, and emerging markets have seen massive inflows in last 6 to 8 weeks. What about valuations, the fear factor, the greed factor, and the margin of safety? Let's connect all those dots and let's understand the current terrain with none other than S Naren, who's one of the finest fund managers in India. Naren, thank you for joining us. Naren, first let's talk about the big picture. Now, it looks is it favorable for the investors, or do you think right now there is too much of hope, which is currently the underpinning factor of valuations?
See, actually, when you meet American investors or you meet any global investors, the way interest rates have moved in the last 6 months has completely changed the way people look at equities. Today, the passing joke right now is that people invest in equities for yield and you invest in debt to make capital appreciation. So that's a kind of environment which has moved in the world. So consequently, I think we have to also remember that even in India, most interest rates have fallen sharply over the last 3 years. If you go and look back in August 2013 as to what interest rates were and what they are today, you'll see that the interest rates have fallen very sharply. So I think one has to look at equity in the context of a lower interest rate world, and that is something that the equity markets across the world is getting adjusted to.
But Naren, earnings for US markets are also looking strong, and selectively emerging market earnings have been decent. So do you think growth is coming back both for developed markets and emerging markets?
No, actually, no one believes that developed market growth rates are going to come back. And after Brexit, actually, we've seen a dramatic change in outlook towards emerging market equities. When we sitting in India look at markets, we seem to be very happy. But if you look at what has happened to markets like Brazil and many other markets, Indian market has actually underperformed in this entire move. And I think clearly there was a phase all the way from 2000 and maybe 13 where the money was just going into developed markets. But I think after Brexit, clearly the outlook has changed and the markets have money has started to come into emerging markets, maybe at the expense of developed markets. And everyone knows that for growth to come back in a big way in developed markets is very difficult because you have such negative demographics that it is very difficult to go to a high growth environment in developed markets. Maybe US is the best of the lot, but I think it will always remain emerging markets for growth.
So, Naren, are you a bit surprised that global markets have ignored the Brexit effect? And do you think it's too naive to actually do that?
See, I think one Britain, as if you look at in the context of the international world, is a much smaller economy than China. Second is, what did Brexit do? Brexit ensured that you're not going to have big rate hikes in most of the developed markets. So the outlook on interest rates clearly became more benign, that the chances of big interest rates in the developed world started to look even more remote. As it is, it was not looking like happening, it became even more remote. I think the combination of the fact that the Britain is not such a large part of the global economy, unlike China, and the fact that interest rates are now more anchored to a lower number clearly helped emerging markets a lot. Clearly, if you see, that has what we in investing think of cost of equity. I think due to the continuous drop in cost of debt, I think cost of equity is also going down, which is actually what was the reason for the trigger. And that is why I think the markets have basically shrugged off Brexit so smoothly, contrary to what people believed on that day. Even we on that day believed there was a buying opportunity, primarily because the as interest rates get anchored to zero, equities become more and more attractive. And the only risk we have to look is there going to be anything which actually takes away this zero interest rate or very low interest rate environment? And we increasingly don't see it.
Hmm. So, Naren, you're absolutely right with the big picture scenario that trillions of dollars of cash currently is lying in zero yields product. But if the hunger to chase yields and chase returns is so strong, do you think the natural migration towards a market like India would be very favorable?
No, it is not. Actually, I would say that what looks to be happening in the world is first look at political stability, and if you look at countries, then you look at fiscal deficit, you look at current account deficit, then you look at growth. So if you have this combination of political stability, you have low current account deficits, and you have growth, then it is true. But if you go through a situation like if you look last year at countries like Russia or Brazil, you had a period where you had very high current account deficits. In that period, actually, these markets did very badly. And so, what the Indian government has done very well in the 3 years from August 2013 to August 2016, that the Indian government and Reserve Bank have managed to get current account deficit under control, growth is moderate and decent, and political stability is there. And as long as you have this combination, I think you are in this world. On the other hand, if you look at a country like Turkey, which doesn't have political stability, then even though you have a zero interest rate world, you're not going to see markets rallying.
Then back home, it's all about GST. So, how do you think GST will change the landscape for Indian economy?
See, GST is something, it is like not something which can overnight change the landscape. There's a lot of work required, there's a lot of transition which has to happen. On the whole, you know that as, for example, what has been accomplished in the last 3 years with high real interest rates is the focus on financial assets. When money starts going into financial assets instead of going into real estate and gold in India, it transforms markets. Like that, as GST gets developed, if you are able to reduce the, if you're able to improve the compliance on most products, what happens is you can have lower taxes and still collect equal sum of money. So these things will play out over a period of time. And one of the things that we have learned over the experience of watching other markets is that at the time of implementation of GST, there are likely to be teething troubles. And one has to successfully cross the teething trouble without losing faith in it. And I think as long as that happens over the next many years, you will see that the size of the organized sector in many industries will go up. The compliance of taxation will go up because of the set-off nature of GST, and in effect, the economy will substantially benefit out of GST. But it is not an overnight mantra. It's not as if GST gets passed and overnight everything happens. It's going to be a long period of time, and India will gain over the next 5 to 7 years out of GST, not over the next 5 months. Over the next 5 months, we could have teething troubles, but over the next 5 to 7 years, we'll be a big gainer.
But Naren, we've also seen a decent run up in the markets. What do you have to say to that? And do you think the gains, what we've seen, at least the recent gains of 5-7% from the recent lows, are they here to stay?
See, I think market always tends to overrate the impact of anything in the short run, and there could be people who would sell on fact, having bought on the hope that GST will come. So in the near term, I don't think the impact is going to be so much. You know what has happened to the e-commerce boom. It is not that people are not buying in e-commerce today, but the e-commerce bubble has got deflated. Like that, there will always be a situation where there will be periods of time when the market overrates the short-term impact. If they correct and they become attractive, that would be maybe a better period for long-term investment. In the short run, markets can move in a way very different to what people are thinking. Having said that, I think GST is a very good long-term impact, and therefore it would actually lead to a re-rating of the markets over a long period of time. In the short run, if it gets drastically re-rated, there is obviously scope for a correction.
But Naren, fundamentally with GST in place, how do you think the dynamics will change for some of the GST related sectors. Let me point out some themes here: logistics, consumer names, and from a GST perspective, do you think there are some mega trends which are at play?
Clearly, there would be, but the way anything happens doesn't happen overnight. So in the long run, you'll have to look at the logistics cost comes down, a number of go downs, and many of the people will drastically reduce the number of go downs. So if you look at it, that can lead to a situation where many of the go downs people come out of because they centralize logistics. So in the long run, it is an impact, but in the short run, it's very difficult to say whether the impact will be overstated in the short run. But what I can tell you from meeting international investors is that GST was a mascot of reform, and the fact that GST gets passed is a clear sign that reform is moving in India, whereas in many other countries in the world, they are not able to do reform. And the fact that India is moving on reform gives India a very good name relative to many of the other countries in the world where reform seems to be stuck. That itself becomes a positive, that the world sees India as a country where reform is happening, and well, they see their own countries as countries where reform is not happening and things are stuck.
What about the premium positioning of India? I mean, India is trading at premium P multiples. Nifty is trading at 18x 1 year forward, above its historical benchmark or above its historical averages. Do you think this kind of a premium is actually justified?
See, one thing I ask people is go back 1 year back. At that point of time, people didn't say that markets are trading at expensive valuation. So let's look at what has happened in the last 1 year. Clearly, you had a bad monsoon that really impacted a number of sectors connected with rural India. You've had a great monsoon so far, and that would help the economy over the next 1 year. It doesn't help July to September data. It helps in the period after July to September. In fact, with a good monsoon, a lot of economic activity gets impaired between July and September. Let's take the second. Last year, people did not recognize the NPLs which existed in many of the companies. Today, the NPLs have been recognized, which has brought down banking sector profits. But is that a positive? Certainly it's a positive, because one of the problems which was known has come out, and due to that, if earnings go down, why should I worry about that earnings going down due to that? The third is oil. Frankly, if you look at it, oil goes down, brings down earnings of the large cap stocks, because many of the companies are connected to commodities. Having said that, are we a gainer from the $42 oil as compared to a $60 oil? The answer is 3, certainly. So I think the way earnings are talked about at this point of time, so the fact that we are benefited out of oil, the fact that we are benefiting out of the recognition of NPLs, and the fact that we are going to see the impact of a good monsoon after 2 bad monsoons, all these factors are not being considered, and that's why I believe that over the course of the next 2 years, earnings should actually improve.
That's a fair point. I mean, the base effect also would kick in, at least for some of the energy companies. I mean, that's a great point. So Naren, I always like to call you the Mr. Contrarian, because you believe in that. You always buy fear, sell greed. So from a market behavior standpoint, you think there's a lot of greed? And where exactly are markets still mispricing growth?
See, I think mispricing is certainly there in sectors like banking. What happens is over the next 2 to 3 years, the problems which have come out in the last 1 year are likely to become not as worrying. So I believe over the course of the next 2 to 3 years, the sectors like banking should pick up. Then if you look at it, the capacity utilization part of it in the economy is improving over the next 2 years. And I think starting 2018, there should be a capex cycle. So I believe that, over the next 2 years, it is the economic cycle which is likely to help the whole earnings environment. You have capacity utilizations which are low, and those capacity utilizations are likely to go up. As I was pointing out to someone, basically, if you look at indicators like, even FMCG volumes, they've been very low because of 2 bad monsoons. Clearly, all these areas are going to see a cyclical revival with the improvement in monsoon this year. So, I think in a whole variety of areas, you're going to see capacity utilization go up, and that leads to actually earnings improving. Having said that, because there isn't big fear at this point of time, to expect mega returns in markets are not likely, because for mega returns you have to buy when there is fear on the street, when there is blood on the street, and that is missing now. So that's why you have to prepare yourself for moderate returns based on the economic cycle, and not mega returns which you get by buying when there is blood on the street.
What is your definition of moderate returns? I mean, if earnings are expected to grow in the band of about 13 to 17%, should we expect that kind of a multiplier?
Yeah, exactly. But I believe that earnings can go up suddenly one year. Maybe our view at this point of time is a year like 17, 18, where you see operating leverage in the economy pick up, can see a good earnings pick up, and maybe 16, 17 can be lower than what people have forecasted at this point of time. So I think maybe over the course of the next 2 years, the market should be in line with GDP, because there isn't scope for a mega re-rating at this point of time. Having said that, I think 17, 18 earnings should be good, and that can lead to temporary increase in PE that can give you an extra return which we cannot forecast at this point of time.
But Naren, what will lead the earnings growth? Ultimately, demand has to come back for earnings to go higher. And if I look at the data points, the consumer is not back. Private sector capex is not on. If all the hopes are riding on government support, and during the GST implementation process as well, since the center will have to share, something with the state, there would be pressure on the deficit.
See, look at it. If you take something like a power utility, over the last 5 years, not too much of new capacity has been planned. Most of the capacity which had been planned earlier has come through. So I think over the next 2 years, I believe that power utility is a sector where the PLFs will go up. When PLFs go up without capex, that leads to increased profits. That's what can happen to power utility. Now, if power demand goes up over the next 2 years, which I think is very reasonable considering Uday has happened and coal availability has improved. It's quite possible that coal demand increase over the next 2 years can lead to profits for companies producing coal. So like that, if you look at the entire banking cycle, the NPL cycle has kind of peaked out this year. Over the next 2 years, we don't think that the NPL cycle will deteriorate. It will improve over the next 2 years. So that can lead to a huge increase in banking profits over the next 2 to 3 years. So due to all these reasons, I believe that market is looking for certain type of improvements. But I do agree there are sectors like consumer and others where valuations are already factoring in earnings improvement. But there are other sectors, because of the long period where for example, take telecom. We clearly think that this year will be the bottom of earnings, considering that there is massive increase in capacity in this year. So I think in many of these sectors, over the next 3 years, things should improve.
If I look at your last declared portfolio, Naren, the portfolio for the month of July, Pharma is right up there. Pharma has been the missing link for from your portfolio for last couple of years. What's the rationale behind this one?
See, simple. Actually, we came to a conclusion when you had most of the Indian pharmaceutical companies had problems on account of plants being inspected and things like that. We feel that is a phase which the companies will see through over the course of the next 2 years. So we saw that as an opportunity, because we clearly see it's a sector where Indians have created huge domain expertise, and we have the ability to make drugs cheap. And the world demographics are deteriorating, and consequently we think that healthcare is one area where expenditures likely to continue to grow in the entire Western world. So we saw these plant related problems as an opportunity to consider investing in the sector. That's how we looked at the sector, and we see again over the next 2 years many of these problems should get resolved, and that should lead to earnings improvement and even PE improvement, because people are currently very worried about each company in the sector.
But Naren, let's look at it more at a macro level. The case for Indian economy is strong. The case for European economy, the Japanese economy, and the US economy is still weak, which means the underlying strength in rupee would be strong. Now, IT and pharma, two sectors, have benefited largely because of the currency tailwind. Now that there is a fair degree of consensus that rupee will not depreciate, do you think one should avoid buying into IT and pharma?
At this point of time, we have that view in IT, and we don't have a negative view on pharma. The reason being that if you look at pharma, there's been a big setback over the course of the last 1 year on account of plant related issues. Clearly, if you look at the global environment, I don't think it's easy to believe that there can be a big growth improvement in any export facing sector at this point of time. And that's why we would have cut our weightage in IT over the period from January, because we believe that this sector is likely to go through lower growth, considering if you look at the market caps of many of the European banks today, they are lower than that of most Indian banks. There are global banks headquartered in Europe whose market cap are lower than Indian banks. So in this scenario, we have a view that it's not likely that you're going to see huge IT expenditure from many of these banking and financial services companies. So clearly, it is one of the areas where outlook has certainly dimmed because of the lack of growth in the Western world.
Naren, I'd like to draw your attention to what's going on in the IPO market. I mean, companies are going public at stretched P multiples. Quest current P multiple is 65 times. You've got Dr. Lal Pathlab P multiples are north of again 45 times. Now, historically, we've seen that whenever there has been euphoria in the IPO market, one should actually sell. So, do you think the action or the frenzy, I mean, that's the right word, honestly, do you think the frenzy in the IPO market is a telltale sign that one should sell and get out?
See, actually, the way the IPO process, SEBI has reduced the entire time period. So earlier, if you invested in an IPO, the time duration, I remember when I started my career in 90s, the time it would take for a refund to come on an investment was 90 days. And from 90 days, the period has come down to a week. So I think, the efficiency in that means that if you're even looking for smaller returns, sometimes because you have such a short period where the money is blocked, those returns are pretty significant. And due to that, I think there is a certain amount of euphoria in the IPO market. I do agree with you that some of the companies may be trading at extremely expensive valuations because of this euphoria, and for us it's an opportunity. Again, the regulator is actually focused on creating a good quality anchor book. As a mutual fund, we get an opportunity to invest in some of the companies in the anchor book, and that has helped our investors, and that where the stocks are locked in for 1 month. So I think the whole process efficiency which has happened is clearly benefiting the system. And for us, we see mispricing because of these oversubscriptions, and the profits do last after the anchor book. We get opportunities to book profits in some of them. So yeah, I do agree there is some euphoria, but I think the euphoria is linked to the shorter IPO period.
So Naren, let me get closing comments from you. What is your current big picture thought, and what is that big new theme which you are working with?
See, I think the big picture thought is that we are hoping, and maybe we believe today that low interest rates are here to stay. And we've been very impressed that if I take the combination of political stability, current account deficit, and growth, India produces one of the best set of things in the entire world. So in this low interest rate environment, coupled with this phenomenal macroeconomic situation, makes India a very, very prime area for people to invest in. And that makes it could happen that over the next few years, Indian valuations can go up. And that is something which will continue as long as we have this combination of low current account deficit, much better growth than the world, and political stability. I think this combination is likely to lead to a re-rating of markets. What we do believe is that investors should continue to have reasonable asset allocation in equities. They cannot think of a one minute immediate increase in equities if they are not invested. And there we have always believed that asset allocation funds do a better job of investing for the long term, particularly when markets are high. So we do think that investors should use asset allocation funds for long-term investing at this stage. And there will be a period sometime in the future where the economic cycle will peak. Currently, if you look at earnings season, it's not a good situation. And I think if the market peak, the earnings cycle will be very good and people will be talking of good earnings. But I think the time to invest is when earnings are still low like they are today. And I believe over the next 2 years, you will have a good economic cycle leading to much better earnings. People are trying to time the earnings cycle. I don't think you should do it. You should invest for the medium term today.
Okay, Naren, so before we wrap the show, I'm just tempted to ask you one more question and just a follow-up to that big trend. I've been told that as a house, you're extremely bullish on hospitals. Why is that?
See, basically, if you look at the West, what you get when you meet the West, you see low growth, you see bad demographics. So if you look at bad demographics, what are the sectors which benefit out of bad demographics? Clearly, it is healthcare, hospitals. These are the sectors which clearly benefit out of bad demographics in the entire Western world. So I believe that if you had to invest for the long term, sectors which bet on bad demographics in the Western world are the best, and that's where healthcare and hospitals come as a very simple long-term thematic investment idea.
Naren, fantastic to have you on this edition of Market Makers. Thank you for tuning in, and thank you for watching this edition of Market Makers.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.